Economic Order Quantity, EOQ, an essential guide to inventory optimization. EOQ is the optimal number of units a company should order to meet demand while minimizing inventory-related costs. These costs include holding costs, shortage costs, and order costs. This inventory management model was first introduced by Ford W. Harris in 1913 and has since been refined to help businesses. The EOQ model helps businesses determine the most cost-effective order quantity, reducing the financial burden of excess inventory. By achieving this balance, companies can ensure operational efficiency and cost reduction. In this guide, we will explore the EOQ formula and its key components, the importance of EOQ across various industries, limitations of the EOQ model, a practical example of EOQ calculation, importance of economic order. Quantity across industries. EOQ plays a crucial role in inventory management by helping businesses optimize order sizes and control costs. Whether in manufacturing, retail, healthcare, or construction, EOQ ensures smooth operations by maintaining appropriate inventory levels. Cost control. EOQ helps businesses determine the optimal order quantity, preventing excessive bulk purchases and minimizing storage costs. This ensures that capital is not unnecessarily tied up in inventory, improving overall financial efficiency. Avoiding stock shortages. Maintaining a steady supply of materials or products is essential for business continuity. EOQ ensures timely replenishment, preventing shortages that could disrupt production, sales, or service delivery. Efficient inventory management. Companies dealing with large volumes of raw materials, finished goods, or supplies benefit from EOQ by balancing order frequency with storage capacity. This optimization improves warehouse space utilization, reduces carrying costs, and enhances inventory tracking. Improved cash flow. Ordering the right quantity of materials prevents excess inventory accumulation. This allows businesses to allocate funds to other critical areas such as expansion, innovation, or unexpected expenses. Reduced waste and sustainability. Overordering can lead to excess stock that may become obsolete, expire, or go to waste, increasing disposal costs. EOQ promotes sustainable resource use by ensuring optimal procurement practices. Graphical representation of EOQ. The EOQ graph typically displays costs in the following manner. X-axis represents order quantity, number of units ordered. Y-axis represents total inventory costs, holding cost curve, an upward sloping line indicating that holding costs increase as order quantity rises. Ordering cost curve, a downward sloping line showing that ordering costs decrease as order quantity increases. Total cost curve, a U-shaped curve representing the sum of holding and ordering costs. The lowest point of this curve indicates the EOQ, where total inventory costs are minimized. The EOQ formula. The EOQ formula is EOQ equals the square root of 2DS divided by H, where D equals annual demand units per year, S equals cost per order dollars per order, H equals holding cost per unit per year dollars per unit per year. Limitations of EOQ. EOQ assumes steady consumer demand, which may not always be the case. The standard EOQ calculation does not account for seasonal variations in inventory expenses. Conclusion. Economic order quantity remains a cornerstone of efficient inventory management. By minimizing costs and optimizing order quantities, businesses can enhance profitability and streamline their supply chain operations. Don't forget to subscribe for more insightful business content.